Are we live? I think we're live. Welcome, everyone. Hello, everyone, and welcome. Oh, I'm playing myself. How's everybody doing?
Good. How are you?
Oh, I'm good. These markets are crazy. Today's been up and down. Pretty volatile today. Good to see you, White Rabbit, Queen.
Hey,
Speaking of,
happy to be here. Ready to
yeah,
learn.
speaking of queens, the queen is dead. Long live the queen, or so they say.
RIP.
Yes. So, for those who are new to the live stream, I just want to welcome you. I am Loose Ventures. Well, that's not my real name, but you know. This is a live stream. We're just gonna discuss stocks, maybe value investing, maybe do some trades, talk about general markets and the economy, and whatever's hot. So I was thinking maybe today we could dive into cybersecurity stocks a bit. I don't know if any of y'all are playing cybersecurity, or if you're looking at cybersecurity stocks.
I'm not playing in it, but I am interested in learning about it.
Ah, I will admit I don't know too much about the specifics of all the cybersecurity software that's offered, but I do know valuation, so that's what I'm going to be looking at. So I have a number of, let's see, cybersecurity stocks here. Let me highlight them. All of which I'd like to dive into a bit more. So I have, what is that? Absolute, let's see, I don't even remember some of these names. Absolute Systems, let's see, ABST, Absolute Software Corporation. That's one. Palo Alto, which is so far I'm feeling pretty good about, just based on initial research. No B4 One, I think is the name of this company, and I believe just no B4. I added too many numbers. I believe they IPO'd not too long ago. Yes, they IPO'd beginning of last year. So this is brand new. I look at new companies with extra scrutiny, but still interesting because they are growing very fast. And Dark Trace, which is one I just learned about and is tanking today. They're down 36.5%. And we could talk about that a little bit more. So let's take a glance at the markets. Let's see.
Is
S&P.
CrowdStrike in your ticker list as well, Luce?
CrowdStrike got ruled out of my, we'll call it, somewhat biased, strict screening process. So my basic screening process starts with an initial valuation, and I'm just looking at face value multiples and stuff, including, let's bring up this screen. So anything related to EBITDA and free cash flow, or I guess those are just a few metrics, but mostly enterprise value to EBITDA and free cash flow yield, which would be free cash flow divided by enterprise value. So I like to look at those two mostly. Free cash flow, I think, is should be one of the most important metrics to look at, or free cash flow yield. And on that metric, CrowdStrike was definitely a no-go. They're actually on my they've been on my short list, although I'm not shorting them. So I think they have a strong business. Right now, I wouldn't buy a stock just because they have a strong business. I'd want the valuation to be favorable as well. And considering that they're on my short list, I wouldn't short a company just on valuation. I'd want to short them on business. So if anything, CrowdStrike's maybe a hold for me. I don't know too much about them. I don't know if they can continue their growth. Let's see. They're here somewhere. my short list is just covered in red for extra confirmation bias. Okay, they're
To
actually
confirm, are you looking at, oh, sorry, go ahead.
no. Go ahead.
To confirm, are you looking at unlevered free cash flow or levered free cash flow?
I am looking at unlevered. So yes, if we look at CrowdStrike, they are low on my short watch list, which is not so bad, I guess is a good way to put it. But I track a good number of metrics. I won't go too much into short watch list. We'll say that for another day. But I see they do have positive cash flow, and well, the free cash flow yield, it's not that bad, but it's 1.3%, and I tend to look for at least 5%, which is high for growth stocks. But I'm a value investor. I don't just chase growth just because I think those days might be limited, we'll say. Maybe not over, but limited now that a lot of money is being pulled out of the economy. So CrowdStrike's there. I'm not shorting them. I am interested in them. I want to see how they continue to do over the next few years. I don't really get FOMO, so I don't care how much growth a company has. I can wait forever because there will always be value opportunities. But from what I do know, they have very strong business. So let's see. We'll start off. I think we'll start with. Actually, we'll start with some notes that I got from Morningstar. This is straight from Morningstar, by the way. So yeah, a lot of stocks, a lot of cybersecurity stocks, they got knocked off the screening process. Again, that has a lot to do with enterprise value EBITDA for me and free cash flow yield. I even adjusted some of those metrics. For example, enterprise value EBITDA. A lot of these cybersecurity stocks, especially the young ones, they are dishing out stock-based compensation left and right. So if you pull that out, then you get perhaps a better picture of how cash flow positive those companies could be. So I'm definitely putting more weight to the free cash flow yield. Not saying they get a pass on all that stock-based compensation, because to me that's still an issue. But because of that, there is a bit of a penalty I put on them in my valuations and my forward projections. And I will assume that they will continue to buy back their own stock as they issue it to themselves. So for the not so greedy companies, you might see total shares outstanding increase maybe a couple percent year over year. That's why you see these small tick ups, for these high growth stocks in outstanding shares, aside from acquisitions, of course, or anything big, So I do penalize them. I do increase the amount of shares outstanding over the next year, 2 years. And that's reflected in my price targets, which are, we'll call them arbitrary to be safe. The price targets I come up with on my own. They are multiples based, but it's my specific process. I'm sure it's very different from many others. So yeah, a lot of stocks didn't make the cut for me. I guess Morningstar mentions Google. Maybe I guess they have some cybersecurity exposure. So I don't know if anyone tracks Morningstar at all. I don't follow them religiously, but I do find their commentary pretty interesting, pretty insightful. Even the obvious things, like they give Palo Alto a wide economic moat. Same with Fortinet. Fortinet doesn't make the cut for me, just on valuation. But Palo Alto, Morningstar says they had a wide economic moat, so I kind of looked into that just a bit. So something like that might make me lower my margin of safety. Maybe for other cybersecurity stocks, I want to buy a stock when it's, 25% below what I think it should be worth. And there's my 25% margin of safety, right? If it has an economic moat and there are other, reasons to lower margin of safety, lower the perceived risk, then I'll go ahead and lower margin of safety. So for Palo Alto right now, I believe I'm giving it a 20% or let's see, 15%, which I think is okay. I think 20% is a little steep, but I'm also trying to figure out, sort of trying to back into a valuation that the markets are currently giving them. So I'll be a little aggressive with the margin of safety there, or perhaps, yeah, I guess that's aggressive. Conservative, I think, would be the other way around. So Morningstar, they are very bullish overall on the cybersecurity industry, and I suppose there's plenty of reason to be, what with the Russia-Ukraine war. So what I've been looking at is price movement for a lot of these cybersecurity stocks. So quick way to reference that would be the ETFs, which the ones I can think of off the top of my head are Hack and Bug. And Bug might be better. Hack looks awful. Maybe it's heavier on the high-flying stocks, the high-growth stocks that took the biggest hits, which is another reason why I like Palo Alto, because if I bring up CrowdStrike, it's not as bad. That's a pretty good drop, but it's not as bad as I thought. Zscaler's another one. That's a pretty good drop. That's about 45%. So from its high in, was that November? Palo Alto's been doing pretty well. So I find their stock price movement a bit more favorable. But if we look at the Bug ETF, which is also cybersecurity, looks a little bit better than Hack. And for those, I'm sure most people can't see the time frames here. This bottom chart here is the daily, 3-year daily chart. And then I have MACD and RSI, a couple other indicators down there. This fuchsia colored line is implied volatility, or implied volatility rank, rather. And then I have 50, 100-day, 200-day moving averages. All these are just colors. I don't really base a lot of investment decisions on a lot of these indicators. Well, maybe implied volatility, but yeah, perhaps more reference than trading signals. So this is the Bug cybersecurity ETF, and just looking at this, there was a pretty good movement to the upside during April when things were heating up, and overall the industry came down with the markets through May. And now it looks like that ETF's getting close to its recent lows. So I think there might be some opportunities in cybersecurity. I think there's plenty of reason to be bullish on the industry. But as always, I still want a value. I don't want to be a price taker. So Morningstar. So yes, Russia-Ukraine war. They're noting that cybersecurity stocks getting pulled down with the rest of the technology sector, and based on their valuations, they think there are plenty of undervalued stocks. I don't quite go by their price targets or valuations. Like I mentioned earlier, I do find their commentary insightful, though. So the one in particular would be, as I mentioned, Palo Alto. So Morningstar sees them as a strongly positioned leader in the industry. Last I checked, they had, I want to say, close to 20% market share in the industry. I was having trouble getting solid metrics, but it looks like it's close to 20% market share in the cybersecurity industry, at least within the U.S., which is really big. So I would consider that a pretty good point to be, because they obviously are very competitive. They don't have everything, where they stand. They only stand to lose, right? And surely there will be competition, but I think I agree with Morningstar on the idea that they have a decent economic moat, and they've been around for a while. They've been growing for a while. So these other companies, none of these other ones, CrowdStrike, Fortinet, Okta, however you pronounce it, and Zscaler, they didn't make the cut. So if we look at Palo Alto, at least at their metrics, I'm I have them based on Bloomberg's projections, which I get from Ticker, by the way, ticker.com. That's this website. There is Palo Alto. And then if you go to estimates, they'll show you the projections. And these are all based on Bloomberg estimates. And it'll even tell you, if you hover over the number, it'll tell you how many estimates there are. Let's see. Go back here. So Palo Alto. Strictly looking at free cash flow yields, 5.6%. It's above my hurdle, which is 5%. Even with that 5% hurdle, I still like to get a discount just to be extra conservative. And I typically get the price that I'm looking for. So kind of prevents me from having FOMO on too many stocks. So Palo Alto for me is pretty close to my buy price. It's not that close, but or it's not, as I would say, it's a great deal. But I'm sure if you rely more on, say, discounted cash flow, you're discounting future cash flows from the next 5-10 years. Palo Alto is probably a screaming buy for you. I typically don't pay attention to discounted cash flows because, well, I think they tend to be rosy, particularly for growth stocks. And, well, frankly, the markets don't really care about your about your DCF. So, all right, let's see. Just checking the voice chat here. Okay. I think everything's working on the live stream. This is, by the way, for those who are tuning in for the first time, this is technically not the first live stream. We had a trial run, if you will, that I will probably make a recap of because I think we covered a lot of stuff. Stuff relating to trading GameStop and insider transactions, just kind of screening for stocks in general. But we talked a bit about Meta, which most people hate, and I don't blame them. But Meta is on my list, by the way, as a value play. But we talked plenty about that, so we can talk about that in another video if everybody wants to. So yeah, Palo Alto, they're looking decent. Enterprise value to EBITDA 26.8 on forward estimates, which is high to me, especially when looking at forward. But as I mentioned earlier, this does probably include a consideration for stock-based compensation. So I'm assuming it doesn't discount that. Therefore, EBITDA might be a little bit higher, bringing this metric down. So either way, I'm not going to give it too much weight. I do want to see what the enterprise value to sales is, considering this is a growth stock, and they're definitely still in growth mode. They have year-over-year growth 25%, a 3-year CAGR of 23%, and then a forward 3-year CAGR of 35%. And that's boosted from this past year, what with all the spending on cybersecurity due to the Russia-Ukraine war. So not sure if they can keep up that 35% rate. Perhaps they get closer to 20%. We could be conservative there. But that's the whole point. That's why I implement a strict margin of safety. That's why I always look for a good discount, just in case anything's off here, anything's wrong, they miss estimates, whatever the case is. But so far, they're doing very well. Another few of the metrics I like to look at: cash return on invested capital. And for the past year, it's 27%, very high. And as you can surmise here, I've sorted all these stocks by cash return on invested capital versus any other metric. So Palo Alto's looking pretty good. I think if you were a growth at a reasonable price investor, you probably are a price taker at this level. They're trading at about 544. Let's see. Yeah, 544. So that's not bad. Morningstar seems to think that they are a let's see, pretty strong buy. They give it 4 stars. Surprised they don't give it 5. So yeah, 544. I might be looking to get in. Let's see. They do have share split coming up, stock split. So I will probably wait for that to take effect. And I'm still worried about the economy overall. Not too worried, not like doomsday worried, but the markets are looking shaky. So I might be selling puts, maybe selling put spreads after they do the share split. Again, I'm not really a price taker. I don't think that between now and 2 weeks from now, I'm going to miss out on 10, 20% gains. I'm not worried about that. It's a long-term hold. So, so maybe hoping to get closer to 500. They're doing a 3-for-1 split, it looks like. So, yeah. What's the math there? Let's see, 140. Try to do quick math. So what is that, like 170 something? Whatever that is. Maybe like 165, something like that. So yeah, I will try to get close to 160, 165. Maybe just by selling puts at or around 500. We'll just see what the option price is doing then. IV, that fuchsia line again. This is the 3-year daily chart. IV's looking relatively low. So maybe after the stock split, it goes up a bit. Maybe the market's turned down a bit more. Who knows? I just want to get a pretty good price. And I don't mind rolling put spreads until I get assigned. I'll make a little bit of premium on the way. So that's Palo Alto. It's looking like a pretty strong company. So I think I could sell those puts or put spreads if I wanted to be more conservative, and feel pretty comfortable about that. Now, these other stocks, let's see. Dark Trace is an interesting one. This is a company based in the UK, I believe. They got little pop-up menus now. Let's see. Yes, based in the UK, and relatively small cybersecurity company. And there's been a good amount of interest from Wall Street up until today, where they announced that the company that was looking to buy them out changed their minds. And apparently there was a snafu with their accounting. And wouldn't you know that the co-founder of Dark Trace, Mike Lynch, had a company called Autonomy, which was sold to Hewlett Packard in 2011 for $11 billion. HP had to write down the value of that company by $8.8 billion. So about an 80% markdown within the following year. Mike Lynch was, of course, accused of fraud. So that's the co-founder. That happened a while back, 11 years ago. Or 10, 11 years ago. Maybe they're a different company. They are down, let's see, now 31%. I think the liquidity is pretty bad, at least on the OTC. If you're trading UK stocks directly, then you're going to get better liquidity than that for sure. But I would like to think that the company's good to go, that was a one-time thing, but this is pretty recent, so I think I'm going to let this sit. Maybe I'll be on the lookout for some analyst reports, see what analysts have to say, but stuff like this, it tends to stick around. It takes a lot to improve investor sentiment from something this bad. So otherwise, they have really high growth. Well, I guess we'll see what the adjusted numbers are. But they had 40-50% revenue growth CAGR. So pretty good. But yeah, potential fraud, not good. So I'm just gonna wait on that one. And this news just came out this morning. So I was actually looking forward to looking into this company, and now it makes it more interesting for sure, but not exactly a screaming buy. I believe this is a CEO. Yes, Poppy Gustafsson. Yes. you could see the fraud in her eyes. No, not really. But yeah, that one just gonna have to wait on. I know Wall Street was hot about this company, but yeah, we'll see what happens now. I'm curious though if any of you know anything about Darktrace. Maybe Mr. Bumbleay, if you're there. If not, that's okay. Mr. Bumbleay's doing some bumbling somewhere.
I'm thinking about this one look like a good short. Like
Darktrace?
Like, yes, puts.
I don't think they... Oh, this is Palo Alto. I was like, oh, it looks different. So no options on the OTC stock. But if you're trading in the UK, yeah, maybe. I mean, it is down 30. Let's see. Can I look at the UK stock? Darktrace. Okay. This is all I'm going to get, at least through Thinkorswim. But it is down about 34, 36%, depending on what ticker you're looking at. But yeah, if you're trading on a UK exchange, on the London Stock Exchange, maybe. But that's a hell of a drop to follow. So I think it's maybe safe to just not touch it for a little while. Someone said my spreadsheet is very aesthetically pleasing. Why, thank you. That's actually purposeful. The only color I don't like is this yellow color, but that's because I want it to be very clear that these industries have very specific formulas for valuation. But other than that, yeah, I try to use soft colors because I hate all the spreadsheets with like very bright red or like the standard green color, like that green. I hate that green. So yeah, I like using soft colors. It just makes it easier to look at, especially at night. If I'm working late, I don't want a bunch of sharp colors in my face. I really don't. So yeah, literally everything about this spreadsheet was about, it had efficiency in mind and eye strain as well. So yeah, I'm quite meticulous, I think, about stuff like that. So yeah, Darktrace is a hold for now, but I do want to watch it, so let's just make that a watch on my little watch list here. There are growth. I think it's safe to mark this one as distressed. So for those of you that can't quite see what I'm doing right here, I classify each stock as let's see what we got here, as value, growth, distressed, cyclical, growth and value, speculative, event, or yield. Distress is basically what it means, or maybe there's just something really wrong with the company, and maybe they're not at risk of going bankrupt, for example, but maybe there's suspected fraud, like Darktrace. So I'll just slap that distress label on there just to let me know I really need to be careful with that type of stock. And I'm probably going to want to look for a very steep margin of safety unless something changes. Another example of distressed companies, or what I would label as distress, would be Stone Company, which is a Brazilian financial services, financial payments stock. And, well, the Brazilian economy isn't doing too hot. So, yeah, so that's another example. What else do we have here? Cyclical, or, like commodities, anything that has a sort of supply and demand cycle in it, such as auto manufacturers, maybe housing, materials. So cyclical tells me that I need to be cognizant of where that company is in the cycle. So a lot of, say, materials stocks are kind of towards the top of the cycle, particularly agriculture stocks. So maybe I want to consider that when looking at agriculture stocks, looking for value plays, whatever the case is. What are the odds that profits fall to we'll call it a more normalized level of earnings in the next year or two, because stocks are priced on forward expectations, not based on what they already did or what earnings they already had. So something to keep in mind particularly for agriculture stocks, even oil and gas. I am loaded up on oil and gas, materials, metals. So yeah, definitely don't forget that those industries are cyclical. Semiconductors, that's a big one. So yeah, and what else do we have here? I think growth and value are they'll speak for themselves. Growth and value, that's sort of we'll call it like a bonus category. That's if there's good growth and I think it's trading at a good value. So rather than just saying value, for example, I have Hewlett Packard, HPQ as value. They're definitely not a growth stock though. So I'll label something as growth and value if I think that there's reason to expect double-digit revenue growth going forward, and they're trading at a damn good value. So Nintendo's one. They're being screwed up by foreign exchange rates. So that one's interesting. Meta, I think, is growth and value. Same with Google, Visa. All have projected double-digit revenue growth, and I think they're trading at pretty good values. Visa might be the closest one to not being, say, like a strict value play. So maybe I'm biased there. Maybe I want to change it to growth just to remove some bias for myself. And I am actually long Visa. And then what else do we have here? Event is if it more or less has nothing to do with valuation or growth or distress, whatever the case is. Event is I am expecting something very specific to happen. So an example for that would be Olin Corporation, which is a chemicals company, and management was aggressively buying back shares and paying down debt. I think they were also pointing out their own valuation quite a bit in their earnings calls. So it sounds like they're trying real hard to be acquired. And I think maybe they mentioned they were in talks, or maybe there was a rumor. So that one I'm kind of just keeping an eye on. If, say, I see like a rumor that the company could be acquired, they're not too big, about a 7.8 billion market cap. And according to my evaluations, they're trading at a decent value, pretty high free cash flow yield. Let's see, forward free cash flow yield 17.4%. So more than triple my hurdle rate. For chemicals, you double your own hurdle rate for free cash flow yield. So that's still high, even if I were to double that 5% to 10% as an expectation. So looking pretty cheap. The one thing I would check there, I would always want to check, are historical operating margins, because that is a cyclical stock. So I like to go to ROIC.ai, and I'll just come down here, look at operating income, and I'll look at the percentage over the company's history. So now it looks fairly elevated, or as of 2021, we're sitting at about 21%. 2020 was a bad year, but I'm sure that was the case for many chemical stocks. Maybe not. maybe they just didn't do that well versus others. Before that, pretty low operating margins. So this could be at risk of being a value trap if margins normalize. So in that case, I might come back here and say, let's look at free cash flow. This is the projection for next fiscal year. And then I have what I call a little sensitivity factor. So if I want to adjust all the projections, just maybe to be conservative, and say, let's see, Olin's operating income ratio was, at a low, it was not even 3%. Let's say they got a lot of synergies from maybe small acquisitions, something like that. Maybe it doesn't drop down to 3% or even 5%. Let's say 10%. So let's cut earnings by, let's cut earnings in half. So if I wanted to do that, I could either use my handy dandy little sensitivity factor, and that cuts the free cash flow yield from 17.4% to 8.7%. So if I wanted to be strict with chemicals in particular, this might not make the cut. So that's something I'm going to be on the lookout for. I could just change this figure directly. So let's cut that in half, about 8% if I change that specifically. So that goes down pretty low if it does turn out to be a value trap. And even if the stock looks reasonably cheap, if estimates are cut in half, the stock price is going to go down. Investors, institutions aren't going to think, oh, but it's still cheap, so I'm never going to sell. They don't hold on despite losses. They will cut their exposure to the company, and at some point, it'll be a very good value to some. So this one, I would say, has some risk of being a value trap. Perhaps a lot of their earnings power is going to hold on. It's going to stick. But I do want to be cautious without diving in too far, or before I dive in too far to any one company. I don't mind being a little extra cautious and maybe missing out on returns here and there. That's okay, because I'll find returns somewhere else. So this one strictly is that event-based category or classification. I'm waiting to see if there's a rumor of a buyout, and maybe I buy some calls, something like that. So I'm just going to watch that one for now. And yield specifically refers to basically free cash flow yield, or just how much cash is available to investors, dividends, available for stock repurchases, whatever free cash they have. If I say a stock is a yield play, that's I guess one way to put it. That's the lens I'm using to look at that particular stock. So examples of yield plays right now would be Chesapeake Energy, Occidental, Total Energy, and which is a French company, by the way. VET, Vermilion Energy. They are Canadian oil and gas. About 45% of sales are from, I believe, maybe not strictly LNG, but we'll just say natural gas. So it's a mixed oil and gas play, which I like very much. British Petroleum, and there's VTNR, but I have that marked as distressed. In Venom, I have as a cyclical play, and I did this before, and I can't remember specifically why, but I tend to trust my past self. So that means I wanted to exercise some caution when looking at Venom. I'm willing to bet myself that it has something to do with price performance. That's probably why I slapped the cyclical label on it, as in I'm not just looking at it as a juicy yield stock that I'm buying no matter what. I'm looking at it as I'd better be cautious about changes in oil prices. So these other ones, I think I'm pretty comfortable. I feel pretty comfortable with these other plays. I will say in general, I always hedge to some extent. And some of these oil and gas plays are basically 100% hedged. Some of them I have locked in profits. I can't even lose money on them at this point. So yeah, maybe that's why I put cyclical as for Venom. That one does have a very high dividend yield, 7.7% forward dividend. Back to cybersecurity. Went on a bit of a tangent there. Let's see. Oh, you want me to share my screen on Discord? Sure. Let's see. Hopefully this doesn't slow things down too much. All right. Should be good to go there. Let's hide that.
Perfect.
All right. Oh, you good? Okay, awesome. Okay, we talked a little bit about Palo Alto. So again, I'm pretty. I haven't started a position in Palo Alto yet. I'm just looking at valuation. I'm looking at fundamentals. reading a bit of analyst reports. When I decide I'm going to establish a position, I'm probably going to dollar cost average. And as I do that, as a position increases in size, I'm going to look more into the company. So perhaps my level of understanding of any one company or stock is directly correlated to the percentage allocation in my portfolio. So if I don't have a position yet, I don't mind not knowing too much about a company's business. I know something about the industry. I know something about the macroeconomics of impacts on that industry. So I think it's safe enough there. If it gets to my price target, I'll start building up a position. I'll start looking more into the company. This is just kind of the way I prefer to do things. I don't need to be specific, an expert in any specific industry. But there are stocks that I will read the 10Ks up and down if I really want to figure out what's going on. GameStop was one of those stocks back in the day. Nintendo's another one. Meta is another. So yeah, Nintendo and Meta being pretty big positions for me. I believe Nintendo's my biggest position. And Occidental is another one that's a big position. But yeah, so as I start to build a position, assuming the price drops, I'll learn more. So what else do we have? Let's go with... We'll go with Absolute, whatever it was, Absolute Software. See, I don't even know the full name of these companies. So I don't have a position in this one yet either. Let's see. Let's bring up the NASDAQ one so it'll actually show me financials. So this company, very small, $552 million market cap. So this one I left a little note for myself. Historical revenue growth is relatively low at relative to the rest of the industry. So they had year-over-year growth of 15% and a 3-year CAGR of 9%. You can compare that to Palo Alto, which is a much bigger company, had 25%, 23% respectively. So I would consider Absolute's revenue growth, historical revenue growth, pretty low, particularly considering that they're a small company. They're very small. So I would think they could grow a little bit faster than that if cybersecurity was increasing in popularity the way it is now. Demand was just going sky high. And I do note that the forward revenue CAGR is 39%. Forward 3-year revenue CAGR is 39%. So they're expecting a ton of growth, or at least Bloomberg analysts are. So we only have 4 or 5 estimates for that guidance, so probably take it with a grain of salt. And yeah, so we have revenue going from $210 million fiscal year ending June 30th of this year, increasing to $244 next year, and then $283 million for fiscal year ending June 30th, 2024. So double-digit growth each year, and they had this massive increase, a 74% increase in revenue for this year. So all things considered, if I wanted to be conservative, I would definitely not assume this crazy high growth that they had for this recent fiscal year. So that's why I left myself a note. I want to know what's the source of that. There aren't very many estimates for that company. So if I really want to get in that company, I'm going to have to get into the stock. I'm going to have to do some digging. I'm going to have to figure out where that revenue growth came from. And yeah, so hopefully that's a pretty easy find. They're a pretty small company, so it shouldn't require too much research. And I also note that the stock-based compensation is pretty high. So if we look at their cash flow, stock-based compensation right above my cursor. Recent fiscal year was about 10.4 million. Last 12 months, 16.7 million. I like to compare that to both cash from operations, which is looks like a about a quarter. We'll just say it's around a quarter of cash flow from operations. Pretty high, I think. You could make the argument that it's not that high for a growth company, for a small growth company, but still it's kind of high. But let's see, 10, what was it, about 11, 10, 10.4, 16.7 compared to 121 million revenue. So a little bit under 10%, and 197 million in revenue for the past year. So they like to issue about 7.5 to, we'll say, 9% of their sales in stock-based compensation. I would consider anything above 5% high, but I know a lot of these growth stocks, they're just going crazy with stock-based compensation, and I think the markets have kind of accepted that. So this definitely isn't the highest that I've seen, but if a company has, revenue growth this high, it says 63% here, it's at 74 in estimates, whatever, that's fine. It does make me wonder, what is the incentive going forward to, continue to grow the company at that rate? And even those estimates that we looked at, 15.8%, 16.3% revenue growth, 2023 and 24. That's still high. That's, good double-digit growth, but it's nowhere near the 74%. So there are questions to be answered here. Again, this stock-based compensation, it's not the highest I've seen. It really isn't, but I am always cautious when looking at any company that's paying themselves a lot of money, because let's see, their operating margins, I would assume, not including stock-based comp, operating margins are decent. They're pretty good. So they're above 20% for 2021, and let's say close to 10% for, just doing the math in my head, close to 10% for the past year. Not bad for a small growth stock. So I would assume this company can afford to pay its employees outside of stock-based compensation. I'm sure they're still going to do it. Any early stage growth companies is going to. So I'm just going to assume that they're giving most of that to themselves, just to management. And another thing I'll check for, and that's just an assumption. So I can check that if I want to, but this is just me being conservative, being biased against any company that's dishing out more than 5% of sales in stock-based compensation. Can't hurt to be cautious. So the other thing I'll look at will be their total shares outstanding. There's a period missing here. Not really sure why, but that's all right. I can always check that later. So they have been, let's see. Okay, so they've been public for, this looks like 10 years now. So, okay. So it's a pretty good stock issuance over the past 2 years. They increased it by almost 20%. Did they do any acquisitions? They did a cash acquisition, so let's see, issuance of common stock. Okay, there's that $71 million of issuance of common stock. Every other year, it's a couple million, 2.1, 1.8 for 2020 and 2022, respectively. So these little cash amounts, that's cash coming from the company, from their earnings, to buy back the shares that management is issuing to themselves. So they'll issue shares basically for free, right? Essentially for free, to a certain extent, and or they'll get very good discounts, right? And then they'll buy back those shares using the company's money. So that's that stock-based compensation. That's what the markets have gotten very used to. I still don't like it, but to me, it's just don't get too greedy. Don't do it too much, because you're literally taking cash out of investors' pockets. Is the way I see it. So yeah, a couple questions being answered here, mainly referring to this massive increase in revenue growth for the past year, and relative to what it's going to be going forward, and maybe I'll look into management compensation. Might look at this cash acquisition they made too. I mean, in hindsight, it's pretty obvious that's why the revenue went up so much. But just curious on the strategy. They're really small. They should be able to grow faster, I would think, than 15-16% growth. So, a couple questions to be answered. At this point, I don't care how undervalued my my own valuations would imply the stock is. Those are questions I want answered, and potential upside could be 1,000%, and I'm still not touching it until I get answers to my questions. So, and you might now get a sense as to why I would prefer a stock like Palo Alto. I don't think there'd be as many questions to answer, or perhaps they're easier to answer. So, okay, so that was Absolute Software. Now we got No B4. Quite the silly name, I think. So No B4. Estimates are 36% revenue growth for this calendar year, 24% revenue growth for next year. Very strong revenue growth projected. Also a very small company. Let's see. White Rabbit asked, did you look at their revenue disclosures? I haven't, but I can tell just by looking, or I think anyone would be able to tell just by looking at their statement of cash flows, they made a big acquisition. So that's it's obvious that's the source of that massive increase in revenue. But this is sort of the initial screening process for me. So I haven't even looked into these companies. I haven't looked at the 10Ks yet. So yeah, this is just initial. Everything I'm finding out right now is new for me. So, but yeah, I would definitely want to take a look at the 10K, see what's going on there. Okay, so No B4. Yes, small, growing very fast. I made a note. Where are you? Here we are. Clear laggard in cybersecurity industry. Their recent IPO, which makes me extremely cautious. I also note that they have very high stock-based compensation, and I'm very specific with my wording, even when I'm describing something as high or low. High means it's pretty high. Very high means it's very high. So take, for example, Absolute Software. I put high stock-based compensation. High tells me that it's high, but it's not really high. So if I say very high, I mean very high. So that's lots of reasons to be cautious about this stock, just right off the get-go. So, okay, very high revenue growth, good estimates. Let's take a look at statement of cash flow. So there's that stock-based compensation. When they IPO'd, stock-based comp was $118 million. It's obviously way more than cash from operations of $30 million. And that compares to $121 million in revenue. So they issued all of their sales to themselves for the year 2019. That's ridiculous. And I think there's only one other company I've seen that's, or maybe a few of the companies I've seen that come close to that. And I think those are Vuzi and Matterport, these VR, AR stocks that, to be honest, they're just issuing all of their sales to themselves. Makes me not want to touch them. It just looks very scammy. So those are only two companies I can think of that have stock-based compensation this high relative to revenue. So that's a pretty big red flag. That looks like everybody wanted to cash out, because surely not all that stock-based comp went to employees. Yeah, they should have the margins for sure. So, yeah, that's a big red flag to me. It was a one-time thing, but still, Now we're back up to last year's 29 million, last 12 months 21.5 million. So over 10% for last year, and we're looking at about 7.5% for the past 12 months. So that's high. And in aggregate, this company, I mean, why would management care if the company stops making money? They've already lined their pockets. So this might sound very bearish on a company I haven't even looked into, really. I haven't even looked at the 10K, but this is part of the screening process for myself. So I don't get FOMO. I will not be hesitant to be extremely prejudiced against stocks that are just companies that are just paying themselves everything that they're making. So another way to look at it is you look at cash flow from operations, and you can see like how much more profitable would they be if they weren't using all this cash to buy back those shares. So the adjustment is there, but there's a sort of, I want to say, around the back calculation you could do where you can basically come back here and look at stock that's been repurchased. So if you net that out, then you can kind of see, okay, it's having a pretty good effect on their earnings on the cash flow from operations. So just something to pay attention to whenever you see cash from operations, see that stock-based compensation. It doesn't tell you the whole picture. So they are using their own cash to repurchase the shares that they're issuing to themselves. So massive red flag. Maybe the company's good to go, but then you have the fact that let's see, over the past year, let's get a quick glimpse at Palo Alto's chart. So we'll look at 1 year daily. So Palo Alto, it's been volatile, but they're definitely up over the past year. Year to date, and just looking at this for reference, I'll just do this. So year to date, they are down slightly. So they're outperforming the markets. So yeah, I mean, that kind of makes sense. All things considered, the bigger company, the ETF, they are outperforming the ETF by a pretty significant margin. So makes sense that Palo Alto will follow the markets a bit, but they are outperforming. And they might be outperforming the industry as well. So that's interesting. So if we come back to no B4, and year to date, they are down. Looks like they're following the ETF. We go back a year, and an even bigger change. So that's about it's a little more than 33% drawdown in stock price versus Palo Alto, which is up from a year ago. So it's those strong cybersecurity stocks, that's what I'm going to compare these smaller companies to, because if they're growing at this high of a rate, 69%, 45%, 41% year over year, and they're expected to continue to grow like that, why don't investors like the company? So I don't just look at a stock and say the chart's down, they're underperforming, it's bad, but markets tend to communicate things about a company by way of buying and selling stock price. So several reasons to be cautious about this one, I think, more so than Absolute Software. But yeah, so Absolute Software, on one hand, you got a surge in revenue that probably won't be replicated. Stock-based compensation is high, but again, it's not terribly high. And on the other hand, you have no B4 with a silly name and is lagging the cybersecurity industry. It's a recent IPO and very high stock-based compensation. So this is another one. I don't even care how much potential upside there is. I'm going to have to dig into it. So I think so far it might not pass my initial valuation, even if I take out EV to EBITDA. Okay. And I'm giving them fat 50% margins of safety. To be honest, no before I think is more deserving of that than Absolute. But I think even if I were to change that to 0, they're still below my price target. So they could be interesting, but I think just based off of this, and some people, you might want to keep looking into a company like this. You like that revenue growth. They're small. You think they can continue to grow. They're only $3.35 billion market cap. Decent margins, excluding stock-based compensation. Cash return on invested capital the past year was good. So there are definitely things that look good about the company, but I would say the red flags kind of turn me off from this stock. So I might cut the research short there and just mark it as a hold. Yeah, I don't know about that one. If anybody knows anything about the company, maybe there's good reason to dig in further. But just off of initial screening process, I don't need to look into this one anymore. So they'll sit on my watch list, hidden. But yeah, I'll just scratch them off for now. So far, just the clear winner, just from the get-go, is Palo Alto. We'll say they win round 1. So this is just the initial screening process for me. Granted, I have put in financials into my spreadsheet here. So I say initial screening process. This is basically half the work for me. Good amount of work already, I suppose. But I'm still going to want to look into Palo Alto, Absolute as well. But I would say Palo Alto kind of wins round 1. So that's when I mentioned earlier, I'm ready to initiate a position, dollar cost average. I'm sure the company's going to be good to go over the long term. This revenue growth should moderate a bit. I know the space is competitive, especially now. There are plenty of companies in this space, so I don't believe any company is resistant to competition. So, I agree with Morningstar that they have an economic moat, a wide economic moat. Economic moats can always be lost, so I don't give too much credit to that. Although I did decrease their margin of safety to reflect their competitiveness and what seemed to be pretty high barriers to entry for cybersecurity. But so yeah, we'll have to keep looking into them. Absolute, I have to come back to. Yeah, that one's interesting. Could be value. Could be value trap. Who knows? What happens if I decrease revenue? On the flip side, Absolute could be one of those companies that just can't become competitive. And maybe to do so, they have to continue to acquire companies, and maybe they have to dilute shareholders. So these might sound like random. This might sound like random speculation, but it definitely happens to a lot of these smaller companies. They want to make acquisitions right off the bat because they got a lot of money from an IPO or whatever the case was. These smaller companies will not hesitate to dilute the shares if they think it's for the benefit in the long term. But if a company does that, dilute shares by, I don't know, say 30%, I'm just going to wait until their strategy pans out. I don't need to get in right then and there. So these companies, I'm not afraid to wait on them so that they can prove themselves. Because if they do that good of a job, then whatever price they'll be at in the future should still be a decent price point. And even if it isn't, if I like the company, if I like the fundamentals, I can just wait on them to get to a certain price point. So just more that anti-FOMO. Let's see. Super simple username. Do you want me to look at Energy Transfer LP? Which is it? Is that just ET? Yes. Okay. And they are midstream, is that right? Let's double check. What's going on here? Oh, it didn't work. Maybe I mistyped it. All right. 7.9% dividend yield. Oh, that's what I want to check. Midstream. Okay. Natural gas. So focus on natural gas. Okay. Okay. So natural gas midstream. I'm pretty sure I already had them on my watch list. What's going on here? Or Google Finance is doing its thing where it just decides to not give me prices. Let's try refreshing. Okay, that fixed it. Or no, it didn't, but that's fine. Let's see if enterprise, energy transfer. Sorry, not enterprise. Let's see if energy transfer is good to go. Do I not have them? Let's see. I might not have them on my watch list. I thought I did. I do not. I thought I already looked at them. Okay. Let's take a look. Let's get rid of all these things. Or just that. I don't want to see trade either. All right. So the thing I will say right off the bat is, and I mentioned this to some of y'all in our little chat. Venom is the clear winner in midstream for me. And once I decide a stock is a winner, I don't change my mind unless I'm proven quite wrong or just wrong in general. So I'm going to hazard a guess and kind of trust my past self in saying I did glance at ET, and when I compare them to Venom, I was like, no thanks, but let's take a look at them. All right, so typically I always want to use it, look at estimates, projections. This is more of a smell check. I just want to see that they are actually growing either revenue or free cash flow. And last year looks like a freaky year for energy transfer. 8.3 billion in free cash flow. That's expected to go down to 5.5 this year and 6.5 next year. So it is decreasing, but perhaps it's not that big of a deal because it could still be trading at a good value. And maybe that involves a good amount of CapEx, as free cash flow deducts CapEx from operating cash flow. So because we can see increased revenue, and yeah, so it might be in the form of CapEx. Maybe that's why free cash flow is down. So maybe it's not a big pain point. So one thing I will look at, ticker will just give me the valuations for the next 12 months. And this doesn't give me unlevered free cash flow yield, but it'll give me an idea. So 14.7% for next 12 months is the levered free cash flow yield. Forward dividend yield, 9.6%. Is that right? Let's see. Let me check on my other screen here. Okay, I'm seeing 8%. I see 8%. Either way, that's high. So we'll just say it has a very high dividend yield. And Enterprise value to EBITDA is below 8, so that's pretty good. A lot of investors look at enterprise value to EBIT for similar oil and gas stocks, and that's under 13, so that's pretty good too. Let's look at financials. So, did they make an acquisition? Or, let's see, or maybe that was just growth. So I'm looking at 2021, 73% growth in revenue, which comes after a 28% decrease in 2020. I'm pretty sure, if I remember correctly, a lot of natural gas companies had a hard time through COVID. So probably, if I had to guess, it's not an acquisition. Maybe that was just organic growth. Or perhaps they did make small acquisitions, but it would be hard to believe that they went from 54.2 billion to 67.4 in 2 years, given the drastic increase in natural gas prices. Because I think they were already moving up towards the end of last year, if I remember correctly. Okay, so yeah. So this is last year. Natural gas futures. Yeah, we started the year close to 250, and at one point peaked at 630. So, okay, that's not hard to believe that there'd be that much of an increase in revenue. So I'm going to assume no acquisitions, or at least no big acquisitions. And that was probably mostly organic growth. So, EBITDA looks good. Should be pretty high for midstream. Well, it's decent. Let's check cash flow. So, lots of CapEx previously. So that kind of it kind of makes sense that CapEx, or that free cash flow, would decrease in the next few years, because it looks like it's been relatively low. Around 3 billion compared to 5 billion, 6 billion, 7.4 billion, 8.4 billion going back each year. So looking forward, expect less cash to be available to investors, and that could be a good thing, depending on what the actual valuation is. So let's say, just doing quick calculation here. So let's say 2023 expected free cash flow is 6.5 billion. Enterprise value today is 98.7. So let me make sure 6.5. Okay. 98.7. Okay, so free cash flow yield, free cash flow divided by enterprise value, was that 6.5%? Just under 6.5%. So for a midstream company, personally, I'd want like double. Let me make sure. Okay, 6.5, 98.7. Okay, so yeah, that's about 6.5% free cash flow yield. So they do have a lot of debt. Total debt 49 billion compared to 8.7 billion cash from operations. And sorry, I'm just clicking around. I'm just doing the numbers real quick. 49 billion total debt divided by 11.4 billion in EBITDA. So, was that like 3.5 times, almost 4 times? Okay, so I guess a few things here. So free cash flow yield, I like to see double. Maybe I'm gonna assume I used to follow Energy Transfer, and I know a lot's changed since I first looked at them years ago. I'm going to assume that the free cash flow is safe. I'm going to assume that the dividend is safe. and maybe that's what makes this a good play, a reliable play. Let's see. Oh, the stock's been on a tear. So at this point, let's look at their debt over the years. I would assume that they want to pay down debt. Because it is pretty high. And if these estimates are close to being right, so you got 13 billion. So debt to EBITDA should drop a fair amount. So you get closer to 3 times, which is nice. Or maybe even below 3 times. So I would say 3 times or less in general is, I think that gets the okay for debt to EBITDA. If it's below, fantastic. I think even here, I calculate medians for everything that I track. So down here, the median for all the stocks on my watch list relating to debt divided by EBITDA is 1.8. So that kind of reflects my bias for lower debt companies. And typically, I find companies that are making a lot of cash flow, that are trading at good value, and they don't have that much debt. So I always kind of look back to these medians whenever I'm looking at a company, and I say, this one's got kind of high debt, and the free cash flow yield isn't the highest, but I still like it, or investors still like it. I just come back here and say, you know what? I can clearly find stocks that have a better value with better fundamentals. Fundamentals in this case, I would strictly be referencing their debt relative to other midstream companies. So, like I think Venom, what is it? 1.4 times, or that's historical. So what's forward? So forward, let's say forward debt to EBITDA for ET would be 3 times. Forward for Venom is 0.9 times, 25% free cash flow yield versus, what was it, 6.5% for ET? So that's a pretty big difference for me. At this point, if I were just now looking at, well, I am just now looking at ET, but at this point, I would look back at my list, at the stocks that I've decided to get into in the same industry, or even if they're not the same industry, just similar style plays. Maybe they're cyclical, maybe they're high yield stocks. They all get compared to each other. It doesn't have to specifically be oil and gas midstream. But at this point, I would say, why buy ET when it looks like I have better plays based on my previous analysis, which I keep up to date, by the way. I just updated projections for all of these stocks here. And these are basically the stocks at the top of my watch list that I'm either already long shares or I'm trading the options, leaps, whatever the case is. So yeah, they don't look like, I know they're a good company. They have a fat dividend. But yeah, it kind of stops right there for me, to be honest. And this is all just based, like, notice I didn't even look at the 10K. So I could definitely look at the 10K and maybe I'd be more convinced that the stock is, it's a very good play. But I am also sort of another thing I would definitely consider. Like, let's say it looked comparable to Venom. Let's say the free cash flow yield was right up there, 25%, and they just had higher debt. They still had that 3 times debt to EBITDA. If I was trying to weed out some stocks, if I was trying to rule some out because I don't want to buy every midstream oil and gas midstream company there is, right? I'm going to start putting those numbers to the test, those projections. So that's where I'm going to come back to my little sensitivity factor here. And I'm maybe going to say, what if earnings get cut by, in half? How does Venom look? Still 12.5% free cash flow yield. debt to EBITDA is still 1.7 times, even if I cut earnings in half. So I feel pretty safe with Venom, and they are backed by Fang, old Diamondback. So I'm feeling pretty confident about Venom. I know that if we were to cut, well, I guess if we just cut it in half, earnings in half for ET, their debt to EBITDA would suddenly go to 6 times. So now suddenly it's really high, and they have to go back into deleveraging mode. So maybe maybe natural gas prices stay very high for the next, I don't know, let's say 5 years, and maybe they're good to go, and it doesn't matter, and ET is going to do well. If that's the case, a stock like Venom, or maybe even VET, again, I don't have to remain with within a specific industry when looking for the best value play, right? Maybe these stocks, if oil and gas prices remain high, let's say at least $80 a barrel for oil, and at least I don't know, let's say like $7 per million BTUs for natural gas. What is it at now? Okay, so it's close to 8. So let's just say, 7's still really high, but we'll just say they just remain high. If that's the argument for ET, and it's possible, it's definitely possible, maybe improbable, but it's still possible. Oil and gas prices remain high for the next 5 years. That means my stocks, VET and Venom, are going to knock it out of the park, because they're probably, I know VET is, but Venom is probably more sensitive to changes in oil and gas prices than ET, and maybe that's why investors are willing to pay that premium for ET, right? Better history, better infrastructure, we'll argue, right? I don't actually know that. Diamondback is pretty solid, but they are more sensitive to those price changes, and they will generate a ton of free cash flow the longer oil and gas prices remain high, both VET and Venom. Since I referenced VET, I'll throw them in there too. So if that's the argument, I'm still choosing VET and Venom. Now, what happens if they drop? Well, Venom still looks okay. VET, forward debt to EBITDA, 0.5 times. So I can cut the earnings in half, and it just goes up to 1 times. Free cash flow yield is still 23%. That's ridiculous. To me, that's okay, I'll take some interim volatility. I don't care if this thing moves up and down, 5 to 10% every day. You're giving me such a ridiculous yield for these stocks. And all that needs to happen, I don't even need a major catalyst. You could argue, for anybody that has experience in oil and gas, you could argue that the only catalyst, quote unquote catalyst, for oil and gas stocks, particularly the smaller companies, the upstream companies, the only catalyst that's needed is that prices remain high for another few months. And that might be enough, or another few quarters, if you wanted to be conservative. Let's go out at least a few quarters. And these companies are going to start to look very undervalued, and markets are going to start saying, investors are going to start saying, but recession and this and this and that. And surely they will respond negatively to that sentiment. But by that point, they're going to start looking so undervalued. To me, they already do. But again, they're going to be sensitive to price movement. That's why I'm in the stocks, but I'm very well hedged. I'm not. I have sizable positions in both, so I don't know if I'm going to be adding now that they've pulled back a bit. But these companies, they can take a decent hit to in terms of oil and gas prices. So a company that has a lot of debt, I can't say the same for. So I think that's probably why I ruled out ET in the first place. You could probably make the argument that companies like Venom and VET, they are way more sensitive to oil and gas prices than ET, that they don't have the same investor sentiment as ET. You could surely make those arguments, and maybe even say, well, I think their dividend's safer than Venom's, Venom's is pretty safe, but yeah, I'm sure there are plenty of arguments you can make in favor of a stock like ET or any other midstream or oil and gas play with similar fundamentals. But yeah, just based on the way I like to screen, the way I look at valuations, fundamentals, yeah, I think I'm sticking to Venom and VET, and Chesapeake actually as a natural gas play. Chesapeake, by the way, is 100% hedged. It's impossible for me to lose money on that play at this point. So, and again, either of those stocks, I'm not sure I would just start throwing money at them today because I already have sizable investment in each of them. So yeah, just my 52 cents on ET. And I don't think if anything, maybe I'm biased against the qualitative side of research. Like I said, maybe I read the 10K and I'm like, oh, I get it, ET. I should get rid of Venom and VET then. But yeah, this is just my preferred approach. It does save a lot of time for me. And I feel like I have to do that when I'm looking at, dozens of stocks every week. We got about 30 minutes to close. Let's see what markets are at. S&P's up 0.35%, or futures. NASDAQ futures 0.13%. Let's see. S&P 0.35. NASDAQ. Oh, that's not NASDAQ. 0.12. Dow 0.33, so in line with S&P. How about the Russell 2000? Oh wait, no, that's Dow. RTY 0.7%. Oh really? Interesting. A little bit higher risk in the Russell 2000. Interesting that that's being bought right now. Let's check volatility. Okay, that's down 1.5%. What else we got? Let's check the euro. How does the world feel about the Queen? I don't think they really care, do they? Markets, rather. So moving back to parity for the Euro USD. Not sure if that's going to hold because a lot of bearish sentiment on the Eurozone for good reason. So I think they just raised interest rates by 75 basis points. So pretty aggressive. It was expected, but still aggressive. But the Queen is dead. Tragic. Thoughts and prayers. Oh. So yeah. What else did you guys want to look at, guys and gals? GSAT. Oh God. Yeah, GSAT got that deal with Apple, which was rumored, and explains the run up in stock price ahead of time. I mean, where, let's say, was the NASDAQ? Did the NASDAQ have a similar run up? Can it be explained by overall market movement? No, the NASDAQ was coming back down. So Yeah, this is a good old case of news being priced in. Although I will say, I don't know, maybe estimates will be given soon. Projections will be given for Global Star. I'm curious how much money they're going to make because, let's see. Let's bring them up here. How big are they? So $3.7 billion market cap. I doubt these estimates are reflecting potential revenue from the partnership with Apple. So now I'm curious. These financials don't look good so far. But I'm curious if this is just what the doctor ordered for GSAT. 135 million in revenue expected for 2022. I assume they'll put some of the expected revenue on the books. I haven't looked into the contract that they have, the specifics of the partnership they have with Apple, but I'm sure some of that revenue will be on the books for fiscal year 2022. But I'm just curious how much revenue they're actually expecting. I haven't seen any numbers. I haven't really dug into it, but maybe this company looks a lot better. I seriously doubt this is including the revenue gained from the Apple contract. I really doubt that, but I don't know. I think I kind of want to keep an eye on that one. This might be one of those rare cases where I look at a company and say, you know what? I don't care that they don't have positive free cash flow because they just got a contract with Apple. And I mean, it's pretty safe to say that the revenue is going to be linked to how many sales of the iPhone 14 Apple can generate. So yeah, I want to keep an eye on this one. And I seriously doubt, the biggest obvious risk would be Apple drops them. They say, just kidding. Maybe it's in the contract. They can just change their minds. It's Apple, right? And they do change their minds on plenty of suppliers. And those suppliers' stock prices just crater. But I seriously doubt Apple would suddenly turn around, within a few months or something like that, and just say, never mind, we don't want to use you anymore. I think Apple's pretty damn picky when it comes to the suppliers on stuff like this, especially new features. I don't think Tim Cook would mess around with stuff like that. They're not known for that kind of stuff. Maybe Amazon, maybe GM, but I don't think Apple. I think we're relatively safe. Maybe, I don't know. Maybe pick up a few shares of GSAT if you're feeling brave. They're down 17% today. And I'm also curious if, let's see, how big, what was it, 3.7 billion? Yeah, 3.7 billion. I know they're going to seek financing. I think it's safe to expect some of that financing to come via share dilution. I don't see any reason why they don't dilute the shares. Well, I mean, I see reason why to not dilute your own shares, but I mean, they could do it for a good premium compared to what they were trading at a couple months ago. So maybe they do a little bit of dilution through shares. I think it'd be wise to raise debt. I know Apple said that they're going to cover, I believe, 95% of capital requirements relating to deploying the satellites. So it's a pretty good deal, sounds like. So yeah, it's probably worth diving into the details of that contract. Let's see, what we got? 24 minutes. I do need to make a trade on DocuSign, actually. So I guess... Oh, HPQ. I forgot. I was going to talk about that one. Actually, if you want to talk about HPQ, let me know in the comments. Otherwise, I'll just go on to... I need to look at DocuSign, and then maybe we could look at GSAT and see if we can find details of the contract. Someone asked, what do I think about green energy and ESG investing? Very positive on the trend due to the political and social environment in Europe. I think long term, green energy it's got a green light, you might say. Green energy is the business, the trend. It's good to go over the long term, for damn sure. Over the next 5 to 10 years, next couple years, if we weren't at risk of a global recession, I would say load up on green energy stocks. No supply issues expected, But seeing as that's not the case, and there are myriad reasons to be concerned about the economy over the next year or so, I think it's better to be very picky with the green energy stocks. Like I just brought up ChargePoint. It's something I've been tracking. I actually had some puts on it that I'm losing money on. But they got some pretty good headwinds over the past few months. But it's I look at a lot of green energy stocks. Like, let's see. If you know some, just throw them out in the comments. I'll just look up some. So C8, is it ChargePoint? CHPT. Let's see. Estimates revenue is exploding. No visible profitability in terms of free cash flow so far. Okay. I'm not going to worry about all the other financials. Let's just see what they're trading at right now. Enterprise value to sales 8.5. So that's the only decent metric, I guess. And that's forward. You could say that under 10 for a high growth stock is good. But there's a reason why companies like ChargePoint have a graph that looks like this, or have a chart that looks like this. So this might be how a lot of green energy stocks look, especially the smaller ones. Like, what about Blink? Are they still a thing? Okay, so they look just like ChargePoint. Although I feel like I've been hearing more about ChargePoint recently. I don't know if y'all can think of any other green energy stocks, like not just small ones, but what do we got? Like Solar Edge. What is that? SEDG? Is that it? Yeah. That one's actually up for the year. Oh, that's nice. So let's see, what's their valuation look like? Estimates. Revenue growth is solid. Weak year last year. That's because of COVID, I'm sure. They're actually going to be free cash flow positive, or they've been free cash flow positive. It's pretty awesome. What's the valuation? It's actually not as bad as I thought. 2%. It's under my 5% hurdle rate, but that's personal preference. I think Warren Buffett has a 5% operating earnings hurdle rate. So maybe it's mostly for the value investors or people that are investing in good cash flow businesses rather than looking for very strong growth. At the expense of or say possibly buying at a relatively high price. I don't know. Maybe this is a stock you pay up for growth. Enterprise value sales is under 5. That's not bad. But yeah, the margins are pretty low. So you're not getting much of those sales as an investor. Not a lot of that is attributable to you. So it's going to be, a company like this is going to be completely valued on cash flow over the next 2 to 5 years, say, for example. But these I am watching. I think solar power has kind of had trouble with margins for a while. I'm not sure if that's going to go away. It does seem like solar panels, just solar energy in general, is from what I've heard, costs have gone down, or prices to the consumer have come down. but a lot of people are still hesitant to invest in it because they see it as an investment, because it still costs a lot of money to not just to purchase like the solar panels, say for your home, whatever, but installation as well. So I'm curious, and this is more of an observation, perhaps speculation rather than, fact or what supply and demand is destined to do. But I'm curious if more companies enter this space and prices start to come down. I'm sure demand will go up, but it seems like demand's pretty sensitive to price so far. I just don't know. Frankly, I know very few people that are putting solar panels on their home or corporate side, I just don't know too many people that are paying for solar panel technology. So for solar energy stocks in particular, I'm curious what happens when competition increases. And if the margins are already fairly low, what happens when margins go even lower because more companies enter the space? Maybe the demand really kicks up and it doesn't affect margins, or maybe it kind of offsets, issues that they might have in terms of competition. And maybe it's kind of like there's enough of the pie to go around, right? But I would see that as something to consider for companies that don't have the highest margins and perhaps don't have a lot of competition. Let's see, what is BEP? Super simple, you just type that. Is it biomass? Is that what you're looking at? I see biomass energy project. Let's go to Yahoo. Let's type in Apple so my shortcut works. BP Brookfield Renewable Partners. I see that UN. I'm sure that's what you're talking about. Okay, cool. Let's see, Brookfield. I think I might have to pause so I can put on my DocuSign trade. Brookfield Renewable. Okay. BPC for us. U.S. American. Wait. What's the difference between corporation partners? Why don't we do... We'll do partners. How about that? Okay, so kind of first things first. I always want to see estimates because I want to know in general, how's the company doing, or how's the company expected to do. So revenue growth, not the highest, but still good, still pretty good. Let's look at valuation. 3.5% forward dividend yield, not bad. Levered free cash flow yield 9.1%. What's their enterprise value? Canadian 69. Okay, so a lot of debt looks like. So that's probably going to be cut like in 3, that free cash flow yield. So it's probably close to 3% free cash flow divided by enterprise value. Let me look at their debt. 23.5 billion compared to, oh, that's pretty high. Estimates. EBITDA, 2.4 billion EBITDA expected 2023. That debt is sky high. Is it a lot of capital lease obligations? Long-term debt 21. No, it's all actual debt. Secured, unsecured debt. That is a lot of debt. I think right off the bat, I would want to see significantly higher growth. Because that's what, like, keep going back and forth, 2.9 EBITDA. or it was expecting 2.4 billion EBITDA. So forward EBITDA, 2.4. Yeah, so that's almost 10 times debt to EBITDA. How are they paying that dividend? Maybe there's something I'm missing. Yeah, maybe there's something I'm missing. This is like an automatic strikeout for me. But like, I don't know. Maybe the company has good positioning. Maybe they're very competitive. I honestly don't know too much about them. But that debt scares me. Like, if I brought it to 10K, that'd be the first thing I'm going to look at. Like, let's see what's going on with this debt. Let's see if they got fixed or floating rates. Because this company looks like a bond. I mean, half the balance sheet is debt, or a little less than half. Yeah. Yeah, I think for me it's just let's find something else. Or maybe if I had like a list of green energy stocks, I don't know how green they actually are, but say I have a list of green energy stocks, there are going to be a few metrics I'm going to glance at real quick, and I'm going to say, oh, okay, on to the next one. As in, I'm sure I can find a company that's free cash flow positive and has debt to EBITDA way lower than 10. So that's kind of how I would look at it. So let me pause this. Well, not actually pause, but I'm going to make a DocuSign trade. Okay, do I have my... I guess I'll bring up... I'll try to explain what I'm doing as I do it. Wait, is this the same window? Oh, whoops. But I do kind of just need to get this trade going. So, and we got 11 minutes till market close, so I'm going to kind of prioritize doing this. All right. So what I'm trying to do is I'm trying to sell IV on DocuSign over the very long term. Fuchsia line is implied volatility. You can see it plummeting after earnings. So I'm going to try to take advantage of that. So I want to sell IV over the long term. It's going to be a long-term play, probably about 9 months. And I'm looking to cash out at 1 to 2 months out because that seems to be the sweet spot for IV to drop. At least that's what's evidence over the past year. The only thing I'm worried about is extreme price movement in the short term. So the way I'm going to get around that is, for example, if I... Let me detach my little risk metric here. Okay, so if I just did that long-term trade, and let's say it's expiring, is it June? Yeah, I believe it's June. Yeah. If the price stays flat, make it max profit. That's real nice. If the price moves more than, let's see, it's at 57.50. Is that right? Yeah, 57.50. If it moves more than $15 up or down, then I start losing money. DocuSign has done this at least a few times in the past, or at least moved a big percentage movement through earnings. You can see it back here in December of last year. Massive move from 234 to 146. Again, for March, earnings in March went from about 92 down to 74. It just keeps doing this. So I want to make it relatively safe trade. So I want to hedge against that extreme price movement. So what I'm going to do is I'm going to open up this June trade, and it's going to be I believe an iron butterfly, if I'm remembering my strategy names. So let's just set it up like this. I'm going to go for at the money. So I'm going to set my middle strikes at the money, and I'm going to go Let's go fairly wide. I'm going to keep an eye on liquidity here. So I might not want to do the odd strikes, but let's see. I might be okay. I was hoping it was going to be around 55 so that I could do 55 to 70. And then on the downside, I could do the strike 40. But I might not get that. I could always adjust. The spreads are looking like crap. Well, actually, they're kind of looking like crap in general. So I might. I don't feel like waiting last minute. Maybe I just stick with 55 just because the liquidity is better. Okay. Let's say I'm going to do 55, 70. Oops, 55, 40. And then I'm going to do, I don't know, let's say 20 contracts. Very widespread still. Let's see. Do I want November or... Okay, November's looking spicy. I'm just looking at the hedge on another screen. I think I want protection out through November. I really wish this would just suddenly drop $1, $1.50, so I could be close to at the money. Let's see. Average trading range for today is about 337. Wait, did IV really drop that much? Okay, no, it didn't. Maybe I just go ahead and do 55. Okay, so this is the short IV part of the trade. And I want to get as close to the market price as possible, but that's 57.50 and the liquidity looks like crap. For all strikes involved, that is, the 72.50s and the 42.50s. So I think I'll take on some price risk there and just go for better liquidity. We're getting close to market close, so I'm not going to mess around with getting filled here. Let's go for that. Let's see if it gets filled. Okay, don't fill, at least not immediately. And we'll do the same thing, but the opposite. So we're buying volatility for November. And put side will be 40. Call side 70. And I'll explain this a bit more once I put the order through, because they have earnings after hours, so this is a very specific trade. And then let's see if I can get in for maybe I go a little lower. Let's do 1095. Why not? Okay, that one went through. I need the sell side to go through, so I'm gonna have to take a lower price there. Let's go for 1230, which is well below. Okay, 1231. Okay, not bad. All right, let me bring up my little chart here, and let's Let's put the stock up on the screen so you can watch me lose money in real time. Okay. Detach. Bring that over here. All right. So this is funky, but this is just the profit and loss diagram of Thinkorswim. All right. So the core trade is shorting volatility. As I mentioned, if you're shorting volatility over the long term, you're making this kind of trade, you want to be as close to at the money as you possibly can. Now, I had to sacrifice on that because of poor liquidity, poor bid-ask spreads. Maybe some people would look at this trade and say, you know what, it's not even worth it because you can't get specifically what you want. But I'm okay with this. I'm okay with the risk. I've looked at this trade beforehand, and I did a little bit of back testing, a little bit of manual back testing. So this is the core trade. As I mentioned earlier, there's a point where DocuSign moves that I'm losing money. There's a point, or to the downside where I'm losing money, and a point to the upside where I'm losing money. The flatter the price remains over the next 9 months through June, the more money I'll make. I don't expect to make max profit. I really don't expect that. It's 0.01% chance of that happening probably. Maybe that's even overstating it. What I would like is for, say, 2 months from now. Let me adjust a little time frame here. So November 18th. I don't care. Let's just say initially I don't care what the price does. I would like it based on my back testing. I would like for volatility to fall, implied volatility to fall about 63.5%. Well, I say about. I'm doing exactly 63.5%. Okay. And that's going to adjust as I'm typing this. Okay. So if implied volatility, if Vega drops 63.5%, the value of these contracts is I'm shorting these options, or it's a net short, it's a net credit. So it benefits me when volatility drops. The value of the contracts will drop overall, the value of the trade will drop, and I'll make money. So what I would like is for in 2 months, November 18th, which is when my short-term hedge expires, which I'll describe in a second, I would like for volatility to drop at least, let's say at least 50%, but this is assuming it drops exactly what I needed to drop. This market close. Exactly where I needed to drop, 63.5%. At that point, I'm going to be pretty damn close to well, I won't say pretty damn close, but I'll be making pretty good profit. This fuchsia line, I guess it's fuchsia. Magenta? Maybe it's magenta. This magenta line is the profit at that point in time with my assumption that volatility will drop about 63.5% across all options contracts. That won't be the specific case, but this is just a base assumption. So I'll be making good money if that happens. However, again, I am worried about losing a chunk of change if the stock moves too far out of my, say, it's about a $15 range I'm looking at the time of entry. So how I'm going to solve that is I'm going to do the opposite trade. So I'm going to pay for volatility, but in this case, I'm strictly paying for, or the goal is to pay for price volatility specifically relating to price direction. So I don't actually expect volatility to increase in the short term because as we can see over the past year, looking at the magenta line, because I think it's magenta, not fuchsia. Looking at the magenta line, after earnings, IV is totally dumping, right? So that would be great for this trade. But as I mentioned earlier, the price definitely moves. So I'm going to hedge against strictly price volatility. if it moves a certain extent, so let's say it moves max is about, well, it's going to be close to 55 is my midpoint, right, for the trade. So if it moves, oh, it doesn't have to move that much. Oh, that's pretty nice. Okay, so it moves $11. Let's say $11 up or down. I start making money on my hedge. So the idea is, and that's smaller. Note that that's smaller than the move that is acceptable on the long-term short volatility, which is about let's see, I said 55 and so 12.50. So it's a little bit about $11. 11. We'll call it about 11, and then I got about 12.50 on the short side. So that range is within, right? So assuming volatility falls as expected, I'm basically looking to make money on any extreme upside or downside. So the specific purpose of that short-term hedge, again, is to protect against extreme price direction. That's why it's so important for me. If DocuSign really didn't move that much through these earnings, but IV was still really, really high, I probably wouldn't be too concerned. Or maybe I'd at least decrease the size of the hedge. There are all sorts of things I could do. Selling volatility over the long term when there's a massive increase in volatility. I mean, it's statistically speaking, it's a money-making trade. So in approximately 2 months, maybe 1 month, but I'm looking out total 2 months. If the price doesn't move, I'm losing a good amount of money on the hedge, but I'm making near max profit on the long-term trade. So it should come out. Let's say the price is flat. It's just, it doesn't go anywhere through November 18th, the expiration of my short-term hedge. Let's see, it's a little less than 13K right there. And by the way, the position size, well, I won't tell you the specific position size, but I keep the position sizes of all my trades very, very small. So I'm making about 12.8K on the long-term trade, and assuming there's no extrinsic value left on the short-term hedge, I'm losing about 10.7K. So that's a 2K 2100 gain, assuming the price doesn't move, which I think is highly unlikely. I think the odds of that are very low. So overall, I think this is a pretty safe trade. Now it just looks all sorts of crazy, but yeah, I think this is a pretty safe trade, particularly with the hedge. Note that the hedge is about we'll call it about 2/3 the size of the long-term short volatility trade. So that's just based on my back testing. So this is a pretty, I think it's safe to say this is a pretty complicated trade for most people watching. Some of you probably know more than I do. So yeah, and if you do and you have a better idea for this trade, go ahead and share. But yeah, this is just based off my manual back testing. I think the price is moving after hours, isn't it? Let's see. Oh yeah, look at that. Do I still have anyone in voice chat? Did you all leave?
I'm here.
Oh, Queen. They've been talking nonstop. I didn't forget about y'all. So that's a pretty big move. What's that?
We're just following along.
Oh, very nice. So let's see. It is at 64. Let's check each side of the trade. Okay. So let's just assume, let's say I don't care what happens in the next 30 days, right? My goal is to cash out at 1 to 2 months out. 2 months might be the sweet spot, but we'll see. And I'll base it off percentage of profit that I'm expecting, right? If I'm making, I don't know, 20% in 30 days, I'm probably going to cash out. That's a good gain on a relatively low risk trade. not considering risk of assignment, which is completely different. So we'll just say in terms of capital put to work and total amount of capital that can be lost, let's just say it's a fairly low risk trade. It's a good potential reward. So, okay, if the price stays flat and it's about 64, yeah, let's just set that there. Let's say 64.50. Fast forward 2 months, drop volatility by my assumption 63.5%. Again, it's just a very generalized assumption, and I am making about 2K on the long-term trade. Let's check the hedge, and I'm sure the price is changing as I'm speaking. So same assumption. All extrinsic value disappears from the short-term hedge because it's the day of expiration. But same price, about 64.50. I'm losing 18.20. So I still somehow made money. It's not a lot, but this is just, assuming the price remains exactly at 64.50, and this assumes volatility drops. So you could see this in hindsight. You might say, oh, that's not a lot of money. Well, this is assuming, one, that the price stays here, right? This is also assuming that volatility doesn't drop faster than what I'm expecting it to. So I think if we look back and we look at IV the day before earnings, it's moving higher. Okay, so it's going to be a little bit different, but I'll be making more money on the short-term hedge, which is good. Okay. So that's not bad. I think I'd rather it move than stay perfectly flat, to be honest. So that's okay. We'll see what that looks like over a month. But if we look at the past earnings reports, IV from the peak, just looking at just visibly what's evidence. From the peak, that's a really big drop 30 days out. What is that? Okay, yeah, 30 days out, that's a massive drop. It's big price movement, but that's a massive drop in IV. So I think it's probably safe to say I'm going to get what I want. So maybe that 63.5% drop in volatility, maybe it's not so unrealistic. So we'll see what happens. This is definitely a price agnostic trade. There is a point where, I'm less happy, right? And it's definitely possible to lose money. This isn't any arbitrage play or anything like that. But the way I see it, the chance of losing money and the max amount of money I can lose is fairly low given the chance for actual profit. And that's going to change over time. So like I was mentioning earlier, let's say I do not care what happens in the first 30 days unless I'm suddenly making a big profit. But even if I'm losing money at any point in time over the next 30 days, I'm just going to keep waiting. And my cutoff point is going to be around 2 months. And the reason for that is because, as you can see, again, looking at that magenta line, implied volatility, it picks up again because the next earnings report is coming up. So that makes a lot of sense. It's the stock price is obviously moving a lot, so that's still a thing. So the markets are very likely going to continue to expect the same kind of movement on the next earnings report. Now, this is all after hours movement. So tomorrow morning, it could just come right back down to, $58. That's totally possible. It could go way down. Who knows what's going to happen? But just kind of for demonstrative purposes, just using the after hours price as a good example. So overall, if I'm losing money over the next 30 days, I'm just going to keep waiting. No biggie. If 2 months out, I end up losing money, I'm probably going to consider closing the trade out because I don't want to get caught when IV starts moving up again. That's not the point of the trade. The point isn't to bet on a particular price. The point is to bet on a predicted significant drop in IV. So that would be my exit trigger. IV starts moving up past 2 months from now, or whatever that point in time is. And I realize that perhaps many of you are probably like I'm never gonna do this trade, or maybe it's a little too many contracts involved, or a complicated setup, surely. But I was planning to make this trade either way, so I figured I'd share. But yeah, again, it's just a long-term short implied volatility trade. And I've been making several trades like this, and they're all looking pretty good. A lot of the big movers, like Roblox. Yeah, I mean, look at that stock. So, yeah, that one I do not mind just waiting out. And look, if you made the trade, wait, actually, I think I did make that trade before the last earnings. So that one I should be doing pretty well on. When did I make it? Is this Roblox? Okay, yeah. Yeah, so I made it before last earnings. Maybe longer. Let me check my... Let's see. Let's see specifically when I made that trade. But I think I've made it on Roblox, on Carvana. Oh yeah, Roblox. Okay. So Roblox, I actually did in February. So I'm still actually waiting to close that one out. But that's at a point where I'm okay. I mean, volatility has dropped quite a bit from this point down here where it's at today. So I think I'm making a bit of money on that one. I think I'm just kind of waiting because I don't really have a lot of risk to downside. I hedged downside, so I think if I just wait, I'll just make more money. So, so slightly different trade than DocuSign. DocuSign, the plan is definitely to cash out within the next 2 months or so. Carvana, let's see. When did I make this one? I believe it was Carvana. Actually, I know it was Carvana. Okay, so this one I made. This one I made right before the last earnings. So IV was pretty high. It's already dropped a lot. So let's see. I should be making money on that. Yes, I'm making. Let's see. Making about 13% so far, if this math is correct. Yeah, about 13% on that one. So that's not bad. Maybe I'll wait a little bit longer. Maybe I'll wait the full 2 months. But I don't want to get caught in what I'm sure will happen uptick in IV as we get closer to the next earnings report. So that will probably be in November, if I had to guess, because the last was August. So yeah, I will be looking to close this out probably within this month. At the latest, the October expiration. But this one actually wasn't hedged. It doesn't have the same hedge as DocuSign. So I think this one, it's probably safe to just, close this out pretty soon. So I am profitable on that one. So, yeah, these trades, they have a pretty good history of making decent profits. So hopefully DocuSign is no exception to that. Still moving up. So, I think it's pretty hard to make volatility trades in this market. There's still an edge you can get, but to a certain extent, or depending on when you trade, what types of trades you're making, you're not on the right side of volatility. So you have to be I think you have to be very picky when trading volatility in these markets. I used to see volatility as like free money when volatility was highly predictable. Like let's look at the SPY, and I think I'd mentioned this on a few talks that I've done in the past. But this is the SPY. You see these spikes in volatility, and I'm sure you can see this pattern. And these aren't just earnings reports. Notice these are every month. So you were having these spikes in volatility every monthly options expiration date and futures expiration date. So that was highly predictable, and it was almost like easy money if you wanted to sell volatility. And I was loving that. And volatility, I wasn't talking about value investing. I was just, trading volatility. Now I think it's a bit harder, as you can see more recently. Yeah, I don't really see a good pattern in volatility here. So, yeah, it's definitely still doable. And there are people that know much more than I do about trading volatility. More equipped, better equipped to trade these markets than I am. But, so yeah, we'll just call it personal preference. Value investing has become my core strategy, while volatility is a very close second, I'll say. So yeah, I want to say that's about all I had to cover. I know some of you are sad that the queen is dead. Long live the queen. Oh, U.S. Soldier, you asked earlier, why did I buy fewer contracts on my hedge? Based on my back testing, it gave me a better risk reward profile. So for example, if the price moved a certain direction, I lost, let's say, X dollars on the long-term trade, and I lost X minus $200 on the short-term trade. Or I'm sorry, I made like X minus $200. So like, in that case, I lost $200, right? But that was a better trade-off than doing a full 1-to-1 ratio, or doing any other ratio for that matter. So just based off of back testing I was doing. So reduce loss to the downside, reduce gain to the upside, but overall it was just better for capital requirement. It was better, I could still take on a pretty good sized trade without risking too much money. So yeah, good risk to return. And again, that's going to change over time, but because it is somewhat of a complicated trade. But yeah, overall, I think it was a good trade. So yeah, sad molasses, happy molasses. I see you're here. I guess any comments or questions before we end for the day? Cash out is the best part of the stream. You mean like cashing out of trades? Oh, don't be shy now. All right. Well, I think that's it. Nobody has any other questions. Gonna go ahead and call it a day. Where's Simple at? I have no idea. He left me hanging. Oh, happy molasses, you're on vacation. Oh, thanks for joining on your vacation. What a great way to ruin a vacation, to join my live stream. Enjoy your vacation. All right, people. I think I'm gonna call it a day. Thanks for joining. If you're new to the channel, go ahead, hit the report button and dislike. I think that's what you're supposed to say. I encourage you to check out the intro video I made. While you're at it, go ahead and check out the disclaimer, because disclaimers are fun. So yeah, I'll be doing more videos like this, more live streams, probably on a weekly basis. Maybe if something interesting happens, I'll just start one up out of nowhere. And or if I'm doing research after hours, perhaps, rather than during the day, and maybe it can be a little bit of a different take, more research focused rather than let's see what's going on with the market. So yeah, if you have any questions, feel free to drop them in the comments. Let me know what your feedback is. This is something I'm new to. I'm not a person that was born to stream. So if you have feedback, I'd appreciate that too. And if there's anything you want to see in particular, just let me know, and maybe we can cover it in one of the next videos. And I do plan on doing a video, at least one video on just my process overall, which I've sort of been peppering throughout the past few videos. But I'll do, say, a structured video on my process, probably relating to value investing and just all the boxes that I like to check. Just so everyone can get a feel for my process, and hopefully it helps you develop your own process, because that's the whole point of this. So yeah, let me know if you want me to cover anything specifically in the next stream. And until then, have a good one. Enjoy Friday. Enjoy your weekends. Try not to lose too much money because the markets are crazy. And I'll probably see you next week. So thanks to everybody for joining, and cheers.